Today we're gonna dive into the turtle strategy, a strategy that hit the news. People wrote books about it because it turned average people into millionaires with a trading challenge. I'm gonna analyze the trading plan, everything you need to know. We just draw it out first, then hit TradingView, hit the charts, and I will show you step by step how this strategy works, how you can use it, and what I would look at if you want to start trading with this. So let's dive into it. The turtle strategy. This strategy, it's one of the first strategies I learned about because it was in the Way of the Turtle, a very common trading book. And it really inspired me to learn more about trading and the markets, to hear that story that they just made an advertisement to look for traders to prove the point that if you give everyone a mechanical trading plan, you can turn them in trading pros, in professional traders, and you can make a lot of money with it. Let's dive into the strategy. The first very easy concept was the buy the 20-day breakout. When price was moving and they were trading this on commodities, eventually also on FX, you can trade this on crypto as well. Every market that tends to trend is a good market for this. With FX, so Forex, that would mean dollar yen, for instance, a great pair to look at breakout trading strategies. Gold also trends nicely. Crypto, very powerful trends. And the stock market in general rises as well. If you look at the S&P 500, for instance, that has been rising for the past 100 plus years. This strategy is trend based. The turtles had two things: the 20-day breakout and the 55-day breakout. On the daily time frame, on the chart, and I'm gonna show you on the charts how this looks, you had two things. If this is the highest high right here of the market. So the markets were trending up and up and up, and then it started to stall, and then it rolled over. It started to decline. Price went lower. We have a top, and this top is 20 days old. Then the next time price hits that level, normally you then wait for a break of that level and then confirmation, maybe the next day you enter. But the turtle traders didn't do that. They entered exactly at that moment of time when price broke that 20-day high. They started to buy. That was the mechanical rule. If the swing high was 55 days old, that channel, looking back 55 days or 20 days, it's the same concept. You can also do it on 10 days. But right now we focus exactly on their trading plan. If you look back and then you spot the highest high, then you take that breakout. But also the other way around. If price was in a bearish trend, so price was going down, this swing right here, that is the 20-day low. Then if price would tank and go lower and break that level, they would sell the market. So they would bet that the markets would go down. That is the exact strategy, the basics, the entry, how to enter the markets, when to take action, when to buy or sell. What is next? Always you have a target in mind and you have a stop loss in mind. That's if you trade without a stop loss, it's super risky. And if you don't have a target, then you need trade management. Otherwise, when do you exit the markets? Not just on emotions. It was a very mechanical approach. No emotions, just simple step by step. With no target set, that means we will have a management style. I will add that later in this video. With a stop loss of 2N. 2N means in the turtle language that you take the indicator. This is the ATR indicator, ATR, average true range, which measures the volatility, how big the moves are in the markets on the chart that is loaded on. You have here the ATR, then I will show you, you normally have a value up left of what the ATR is on this exact moment of time when the entry occurred. So that's right here. Let's say it was 10. Then what they did was multiply this figure, so 10, and multiply that by 2, and then you have 2N, so 2 times volatility. That is your stop loss. So that would mean, let's delete all of this. That would mean, let's say right here the entry is, they buy, then 20 points lower or 20 pips lower, whatever figure you use or measurement, 20 points lower, the stop loss was placed. You always have 2N risk. If you start to move higher, if you add half of this 10, so half an N, then you scale in. That is the second rule here about risk management. Every 0.5 N you scale in. They started to buy the position when the 20-day breakout happened, and then when price is moving higher, let's say that's here, so 5 points higher, 10 times 0.5 is 5, then here they buy again. But they always keep this 2N distance of the stop loss, so your stop loss of the first position and the second position, they merge, and then you trail it, more on it later. But this is the philosophy behind that rule, because I always find it interesting to know, okay, why did I do that? Well, they figured out that a lot of breakouts turn into fake breakouts. You break a high, let's say you break this high, and then price does go a little bit higher, but most of the cases it just rolls over. That is that you're trapped in longs and then you roll over. Not always you have that big trend where they made a lot of money. So they were starting to think, like, how can I fix that? How can I take all the trades, because I never want to miss a breakout, because every breakout can result in a trend and you need to catch the trends. They were thinking, okay, how can I do this? And then they realized, okay, let's just scale in maximum of 4 times. So 4 times every 0.5 and in the right direction. That means the higher we go, the further we go in the trend, the more confirmation we have, the larger our position becomes, and then we are more right than wrong, because the first position has the biggest probability of not playing out. That is what they were thinking, that was the psychology, and in hindsight it worked very well for them. Let's move to the next one. Max 4 positions. That is like what I told you, stacking, stacking, stacking. There's one more rule with that max 4 position. Max 4 positions is your price moves up and then they scale in. What happens with the stop loss? How does that work? You'll have an entry price of your first position, then your second position, and then you have 2 units open, for instance, 2 positions, 2 lots, and then you have a stop loss here, but where to place the next stop loss? Let's say you have a 1% risk position on the first buy, then another position on the second, then you take your average price, so the 2 entries, take the average, and then you calculate your stop loss if you have this 20-point move. Their stop was always the 2N, yeah? Always the distance was 2N. Every position, it just moves higher. That is the max 4 positions rule, very important. Exit 10 or 20 low high. This is that management style. We don't have a target set. If you don't have a target, you don't have a place where the market will stop for you, or your broker will stop the trade for you. And I have a lot of strategies with set targets, but sometimes you have a management style and then you don't know where to target, but you just want, if it keeps exploding, just trail your stop loss, lock in profits, and you want to capitalize on that big move. And that's exactly what they did. They did an exit on a 10-day low and a 20-day low, or the 10-day high and a 20-day high, depending if you're long or short, if you buy or sell. Here, of course, we buy. Let's say then you have the 10-day low, that is this one, or it is this one, or it's between here. And then this stop loss keeps trailing, and then if it breaks, or the stop loss doesn't have to trail, but at least your algorithm or your strategy, when that low is taken out, then you exit the position. Super important. Then never miss out. I already introduced a little bit about algo trading with you now in this video. What we do is all these strategies, if it is the turtle strategy or if you have heard of any other strategy in trading, we've probably automated it. And we do that with no-code automation on the Profectus AI platform. This allows everyone, just every trader, to automate their strategy and test it. But also, besides testing, run it live, and then it is always at the charts. A big issue, and they experienced it as well, is if you're trading, you need to sit. The biggest thing in this challenge was they need to sit behind the screen, be sharp, are focused, and never miss a trade. Because the probability, like I said, of a big trend, a big trade, is pretty low. So if you miss exactly that one, you're dusted, right? You need to catch all the opportunities. And that is why I automate. That's why I love automation. Like I said, it allows me to test if a strategy works. Like this one, I've tested it with a 20-day breakout, 10-day, 3-day, 8-day, all the variables you can imagine, with target, without target, with a stop loss of 2N, 1N, 1.5N. I've tested it all on all types of markets, crypto, stocks, and FX. And it is now automated as well for me. So if you want to learn that, you can join that platform, play around for free. Link will be in the description, or just find profectus.ai. But never miss out is so important, and therefore I automated. You can also just trade certain sessions, but sometimes the markets don't care about if you're awake or asleep. Something happens, there's an opportunity you don't want to miss out of. And then reduce in drawdown. Very interesting rule. I personally haven't played around with it that much, but what they do is, let's say you have a 1 million account, and then if I hit a 10% drawdown, so my account goes back to 900k, what then happens is they stop risking like 1% per trade on that 1 million account, but they do like they are trading an 80k account, so 20% less. So when traders started to perform well, and then they started to perform worse based on the markets that change from certain trending markets, consolidation markets, then they also risked down their positions. So their drawdown wasn't that deep, and then the next time when markets became better, they slowly started to increase their trading size again. Very smart way to reduce your overall max drawdown. It's definitely interesting to analyze, to reduce when you hit 10% drawdown, reduce your size of your account like 20%, or at least your stop loss risk. Let's dive into TradingView now, and let me show you this in action. We are here at GJ pound yen on a daily time frame, and we have this setup here on watch. We have this white line. Let me zoom in, and what we were looking at was, this is the highest high of the last, well, a lot of days, right? Since here to the left we have 10th of April. All this whole trend here is bullish, and this is the highest high in that whole period. So this is the 20-day high, but also the 55-day high probably, if we look back all the way. What's next then? When we hit that level, we instantly buy. So this candle just crossed it, and then we went long, and then we need our stop loss to be 2N. We have the ATR here. You can see if I move my cursor, we have this value here down left changing, and that's that value that I talked about. Right here you see the ATR is slowing down, is getting lower and lower. That means that we went from a volatile market to a less volatile market. That's how the average true range indicator works, and this is what the turtle traders used. We are here at a value of 1.618. That's a Fibonacci sequence. Super interesting that we hit that number, by the way. That's weird, but you need to take that number times 2, and then you have 3.2 as a stop loss. That is right here. Then the next rule I talked about was, after you set your stop loss and you buy, we need a level higher than this buy, and that is this level here, and that is that half N higher, and then if that is crossing, you buy again. We have 1.618 as the ATR. Our level becomes then slightly higher, 0.8 higher, because you divide that number by 2, right? You multiply it by 0.5. So if we break this, some things happen. Let's see. Okay, we now break it. You're live at the market, so you don't miss this trade, or you automate it and you never miss a trade. Where to place the stop loss? You can say 2N, but that was not the rule, because we already have this position. So if you take this position, this entry and that entry, and then calculate it, you will end up with a stop loss around here. And then you keep managing this, because the management of this particular strategy was a trailing stop loss. So let's say the 10-day lows, so you trail your stop loss like this, if this is of course in profit, and then eventually it plays out or it doesn't. This is a strategy I've tested a lot, and it's a very interesting strategy to trade. I love it. I have some variations on other time frames, so I'm not just following what the turtle traders did. I think it's very important to build a strategy and test a lot of things, different pairs, different time frames, different management styles, different target and stop loss, because nowadays with new technology, you can do that so quickly. It doesn't take you months or years anymore like they had to do it manually, but it takes literally hours and days. So thank you for watching, and I see you in the next one.